welcome to Aspire to Retire. I'm your host, Cheryl Nelson. I'm here with Ralph and Tim Short, along with Scott Earhart, all from Welcome Home Financial Partners. As always, good to be here with you guys.
Good seeing you.
Thanks for having us again.
So today we're talking about taxes, taxes, taxes. Do we ever have to stop paying them? I wish. How do we keep more of our hard-earned money in our own pockets? To achieve our financial goals, we need to optimize our tax situations and maximize our savings. Easier said than done, I know. So let's dive right into this, guys. Can you provide an overview of the importance of tax planning and how it affects an individual's financial well-being? We all want to know the answer to this.
So what it really comes down to is this. A lot of folks nowadays are saving in pre-tax vehicles. So that money that's in there has never been taxed before. So when you get into retirement and you take distributions, you're going to be taxed. Now, how much we're going to be taxed in the future, I don't think anybody here brought their crystal ball with them. We don't know. We do know that eventually the tax rates are going to go up. So when it comes to taxes in retirement, if you don't plan properly, you could lose out on a couple $100,000 because of not doing proper tax strategies.
But I would also say people need to understand, what is your goal? Some people want to not have the pre-tax today because they want tax-free money coming later down the road,
Right.
because they do feel like their tax bracket is going to increase. Now, we've been told all my life, let's say, that the reason that you want to go with pre-tax money is because you can deduct it off your income today, because when you retire, you're going to be in a lower tax bracket because you're not making as much money. But from my experience in dealing with clients here in Richmond, most of the guys are going to have more income in retirement than they did when they were earning that income, because guess what? Now they got a pension if they're lucky, they've got Social Security, they got RMDs, they've got taxable income coming to them. Correct, Scott?
Absolutely. There's no way that, as Tim said and Ralph is talking about, there's no way we can tell you what tax rates are going to be in the future. What we can tell you is you're going to have to distribute money to yourself. You have to pay for your lifestyle in retirement. And for all your working years, all of our working years, you know, your company was helping you withhold taxes. You weren't paying the full tax rate yourself. Now in retirement, you're paying yourself. So you've got to pay all those taxes, and you have to be very, very careful about where you're distributing money from.
Now, what about folks in the military, our veterans? Thank them for their service, of course, but they have their military retirement, a lot of them who put in, 20 plus years. Is that tax-free money?
In certain situations it would be. It's just according to where they live at that point in time. So what I would just say, every person, their occupation's a little different with what's going on with the tax situation, because taxes will change. Their viewpoint on what needs to be taxed is going to change. I mean, disability is one thing that you don't have to really worry so much about, but guess what? That may also change.
My goodness, so many changes. That's one thing that we know is certain, right? Tax laws are probably going to change. So why is it essential for viewers to consider tax strategies then as part of their overall financial plan?
Well, it's essential for distribution purposes. You know, whether you're choosing to use a pre-tax or a post-tax vehicle to accumulate, at some point we're going to start taking that money out, right? We all save for retirement because we want to enjoy that money, use that money to fund our lifestyle. And it's very important to have diversified strategies and understand what those are, because as we alluded to in the last question, how are you going to be taxed when you do start to take possession of those funds?
And why not lower your tax liability, right? Why not pay as little as you possibly can in order to accumulate as much as you possibly can? So there's different vehicles that you can use, but the thing that you have to realize is that no matter what, you're going to have to pay taxes, whether it's coming into it, whether it's coming out of it, there's going to be taxes there. But you can strategically set it up in a way to where you're going to minimize the tax dollars that you're actually paying. So it's not about percentages, it's not about tax rates, it's, hey, how much can we save tax dollar wise between now in retirement and in retirement?
So I would say to you this, and everybody in the audience here, your job is not to pay the most taxes that you can, is to minimize, but pay your taxes.
Yes.
But minimize it.
Right, right. Always pay your taxes. You don't want to be getting in trouble, that's for sure. So let's talk about some more investment strategies then that we can all employ to minimize our tax liabilities, such as things like tax efficient fund selection or tax loss harvesting. Explain what those mean.
Well, tax loss harvesting is if you've got non-qualified accounts where you have individual stocks or things of that nature, and you've got this one here that's earned, say, $100, but over here you've got one that lost $100. So guess what? If you sold it, there's no tax liability at that point in time.
Interesting.
So it's just different ways of approaching how you take money and invest money and look at it from a tax standpoint.
Yeah, and these are one of the things that we talk to folks about because it's not, the same across the board. There's different taxation, whether it's short-term capital gains taxation, long-term capital gains taxation. There's so many things to talk about, but it's always individually based. So that's why you can't just throw out that generic answer of, hey, this is what we should be doing or this is what you should be doing. It's let's take a look at what you have going on, because sometimes there is a way you can do some tax harvesting, but there's going to be losses occurred with that. So there's different things that you got to take a look at, but that's where second opinions come in. We love to sit down, have the opportunity to sit down and talk about how we can have some tax strategies.
Yes, yeah, because I know I couldn't do this alone. That's where all of you professionals come in. And what about tax advantage accounts like IRAs and 401ks? How do they work, and what's their role in long-term tax planning? I know we talked a little bit about Roth versus regular IRA.
Sure. So 401k, anything, 403b, 457, these are all going to be things that are offered to you through your employer. And you're more than likely going to get a match. It's going to grow, and very, very worthwhile vehicle for you. Now, if we're looking at IRAs, Roth IRAs, SEP IRAs, or not SEP IRAs, but individual IRAs, things of that nature, that's going to be something that you contribute to on your own, and you are going to, if it's a traditional IRA, get a tax deduction in the year you contribute to it. If it's a Roth IRA, you don't get that tax deduction, but guess what? When you retire and you go to take that money out, you get it tax-free. These are all things that are available to all of us as Americans, but you need to be working with a financial professional to understand which one's right for you in your scenario right now.
Yeah, because there's always rules and restrictions to each one of those plans, so you got to make sure you follow those, or it's not going to happen the way you want it to.
And what I would say is don't get caught up in the 401k or 403b. That's just a tax code of a retirement plan, and it's based on what industry you work for. It's like 457 is going to be government, 401k is the private sector, 403b is nonprofit. But don't worry about that situation.
Okay, thanks for breaking that down, because you were throwing out these numbers and I've never heard of some of them. Going, okay, what's that? So now we know, and we have a special offer for our viewers. Tim, tell them about it.
That we do, Cheryl. So for the first 10 callers who have saved $250,000 or more for retirement, pick up your phone, give us a call, 833-897-4845. We'd like to personally invite you into the office where we will create that very own retirement roadmap just for you. Talk about some tax strategies as well, and the best part is, Cheryl, we'll do it on a complimentary basis.
Do you hear that? It's going to be free. So call right now or take your cell phone and scan that QR code on the bottom of your screen to schedule an appointment. We're going to take a brief break, but that number one more time is 833-897-4845. Give us a call right now. Coming up next, we will discuss more tax categories and those tax law changes. Stay with us.
Imagine the future you've been wanting all along. A world where your retirement income is covered and you don't have to worry. Your financial assets are protected, and you have an experienced team fighting every day to grow your assets. Imagine a company creating tax strategies and legacy plans to make sure your loved ones are protected no matter what happens. At Welcome Home Financial Partners, we're an experienced financial team with the right professional licenses and an unbreakable commitment to making our clients feel like family. Here you'll find determined, friendly faces in a world filled with obstacles and problems. We help plan your retirement income to ensure you won't run out of money in retirement. We build in protection to make sure your assets are covered on all sides. We focus on growing your wealth to combat inflation and rising cost of living. And we design tax strategies to help you avoid paying back what you shouldn't while protecting the people you love. Our team never stops fighting for you. With an unparalleled work ethic, we work hard because we know your future depends on it. We're proud to help you choose the life you want to live in retirement. Welcome to your financial future. We're so glad you're here.
Welcome back to Aspire to Retire. We're talking all about taxes today, something we cannot avoid. And I know a lot of us now are small business owners and entrepreneurs, so we're probably wondering, what are some key tax planning considerations that we should be aware of? I'm a small business owner. I'm wondering this.
Well, one of the first steps that you need to take is you need to get a good CPA, right? The CPAs know the laws ins and outs. We're not tax professionals. The CPAs are going to give you the advice on, hey, this is what you can do, this is what you can't do. But there's a lot of opportunities out there right now that a lot of small business owners and a lot of self-employed folks, they don't know. And those are things that you really need to get a hold of, because you know, if you could save yourself a couple $1,000s a year in write-offs, or let's just say maybe even tens of 20s thousands of dollars, there are ways that you can save that money, put it into your SEP IRA if you are self-employed, and have a great retirement plan built that way. So there's a lot of tax advantages that you can get from a CPA.
So one of the things I would say is, just because a person that does your taxes doesn't necessarily, they understand how to fill out those forms,
Right.
most of them. But the other thing is, but they don't understand how it affects you down the road. So you always need a kind of a second opinion on that. And that's kind of where, if you build a team with financial advisors and your CPA,
Yeah.
that's a good working arrangement at that point in time, because I've got one client right now, or prospect I'm working with now, who is making around $500,000 a year in his business.
Wow.
And his accountant has never talked to him about setting up a retirement plan.
Really?
And he has lost so much
Oh.
money because he had to pay taxes on it, where he could have deducted it from a retirement plan, things of that nature. So just understand that there's a difference between being able to do your taxes and tax planning. Would you understand?
Absolutely.
Yeah, you need a lot of people on your team, because you can't do it all alone. I mean, you can try, but you're probably not going to get the best outcome for that. So that, and then knowing the tax laws, because tax laws change a lot. And so what advice can you offer to our viewers on staying informed about tax law changes and adapting their strategies?
The best advice that I could give to somebody in that scenario, or that has that question, is exactly what Ralph just said. Get yourself a team put together. Have a CPA, a tax preparer, and a team of financial professionals that are invested in making sure that you maximize your earnings every year, also maximize your retirement savings, so that you can get where you want to be.
Yeah, absolutely. Now, I mentioned tax categories before the break. So what are the fundamental tax categories that our viewers should be aware of, such as income tax, capital gains tax, and estate tax? All of this makes my head spin. Break it down.
So what I would say to you, number one, is income tax means how much did you earn this year? They're going to tax you on your income. That's
Okay.
why it's called income tax. When it comes to capital gains tax, that basically means that if you hold an investment for more than 1 year and you purchased it at $100 and you sold it a year after you bought it for $110, you're going to have to pay capital gains taxes on $10.
Oh.
Now that tax rate is going to be different than your personal income tax, okay? Then you've got estate tax. That's basically how much more do you have when you pass on, and you've got a certain amount of money that you can pass on without any taxes from the federal government. Then you got another estate thing that you may have to pay taxes on your estate.
Is that also, sorry, I didn't mean to interrupt you there. Is that also called the death tax? The same thing? I will never understand that, why there's
Inheritance tax,
Yeah.
death tax, estate tax. It sounds sexier when you say estate.
Oh yeah, nobody wants to say death tax, right?
But
Oh.
at the same time, that's basically what it is, because not only do you pay taxes 300 or 400 times during your lifetime, now somebody else is going to have to pay an estate tax if you've done a very good job of
Oh my gosh.
accumulating assets.
And the worst thing that I think for our viewers, and why they need to have professional help, is all of those taxes, they're not going away, but the rates do change and the regulations on them change pretty much annually.
Right.
So it's something you need to stay abreast on.
So let's talk about the current threshold then for estate tax, and how might that change in our estate planning?
Well, what I would say to that question is, the reason that it would change is because our government officials probably need to incorporate more monies as revenue for themselves.
Oh, boy.
So they're not going to reduce those taxes for that purpose. So you probably are going to have estate taxes that might be lower because they're going to need more money.
And by lower, you mean the threshold to
Threshold.
pierce is going to be lower. So if you, right now, you need to be pretty wealthy to
Yes.
worry about estate tax. If it
From the
changes
federal standpoint.
from the federal standpoint, yes. In the future, I would say that number's coming down. So maybe upper middle class people need to worry about that.
So is not everybody taxed on the estate tax then when they pass?
No,
No.
Oh.
because you have to have a certain amount of money, and it does change. It's over close to 11 million now, so most people are not going to have to worry about
I
it.
see.
However,
Okay.
that doesn't mean that the state of Virginia or Maryland or whoever doesn't have a lower one. So they're still going to pay
goodness.
taxes.
See, yeah, everything changes.
And there's a lot of things, like you say, there's a lot of things that change constantly,
Right.
right? So back to like kind of capital gains, there's two different types of capital gains. You got short-term and long-term. Right now, they're two different rates, but they're in talks of changing long-term to short-term and so on. So we don't know what things are going to do in the future. That's why you always have to have a well-prepared plan.
Yes. So are there any other recent or upcoming tax law changes that we should be aware of?
Well, what I would say is it's always going to change. I mean, it used to be short-term, long-term capital gains. Now the short-term is taxed as income, not short-term capital gains. So, you know, you say tomato, they say tomato. So, you know, it doesn't really matter. The end result is how much do I have to write a check for to pay for taxes that they probably don't deserve, but they're going to request it.
Right. And in the near future, it was 2026, correct?
Yep.
Where tax rates are going to change.
Oh, no.
Not all the rates change, but most of the rates will increase. So
Great.
those are future things to talk about. So at the end of the day, control what you can, and those are things that we can help you do. We can't control what the government's going to do. We can't control where tax rates are going to be.
Yeah.
But hey, what if we can minimize your tax liability right now, or maybe make some money grow in a tax efficient way to where you don't have to pay taxes down the road.
Absolutely.
And that's key. If you are aware that these are out there and you are working, you know, talking to people, getting a plan together, you can plan for all of these things. We can help you do it, your CPA can help you do it, and you can be prepared and handle anything that the tax code's going to throw at you.
But I
Yeah.
would also say they need to take into consideration that they're going to have to start pulling money out of their 401k pre-tax accounts, and they're going to start paying tax at a certain age, okay? And that does change. But the other factor is with the new tax laws with inherited IRAs for their, not their spouses, but their kids or other beneficiaries, they're going to have to be very aware what that tax ramification is for them.
Goodness, so much to think about here. We've got to take a break, but before we do that, Tim, our special offer once again.
Absolutely. The first 10 callers who have saved $250,000 or more, pick up your phone, give us a call, 833-897-4845. We love the opportunity to sit down with you in the office where we can talk about these tax strategies and create your very own retirement map. And the best part is we'll do this on a complimentary basis.
All right, we love that. It is time for that commercial break, as I mentioned, but keep those questions coming. Take advantage of these guys. Our professionals are here. Call once again, 833-897-4845, or scan that QR code on the bottom of your screen. Coming up next, we will feature some of your burning questions. Stay with us.
It was the longest running bull market in history. Everything was looking up. While inverted yield curves pointed to a recession, the market kept going. And then, if you're planning to retire soon, that could spell bad news for your returns. Our team can help you better withstand the bear market. Now more than ever, you need a financial professional to stand with you. Visit our website to learn more about our services. You can call or email our office to schedule your complimentary consultation today.
Welcome back to Aspire to Retire. It's our favorite part of the show. Time to feature you with some of your questions. So we're going to start with Chuck from Sparta. Chuck says, I've been retired for several years and I got a letter from the IRS saying that I need to take money out of my retirement account. Is this a scam? Ooh, I hate it when you get those letters in the mail. I always wonder if it's a scam too.
So my question to Chuck is, did it scare you to death when you got a letter from the IRS?
Yes, we don't
But
like getting those.
what I would say, if what you're talking about is a pre-tax account like your 401k or an IRA, that is not a scam if you're 73 years old. So if you're 73, starting to now, you're going to have to start taking money out. And they're just saying to you, you have to. Now, if you don't take it out, there's going to be penalties from that. So you need to be aware of that.
Yep, what Chuck's referring to is called a required minimum distribution. It's part of the tax code. Everybody that achieves age 73, if you have qualified accounts, you have to start taking dollars out. So no, it's not a scam, but certainly there's some strategies that we could help you with to, minimize the effect
Right.
that that's going to have on you and your income taxation.
But it's just like a lot of clients will call up about that saying, why do I have to do this? And I'm like, because that's the law. And it's just one of those things that you just have to face and move on.
How do you know, though, when you get this letter, if it's legit? Because I've gotten some scam letters in the mail, too, and sometimes people fall for them because they look real.
One of the things I would say to you is that more than likely your company where you have your money, you should also have received a letter from them saying that. So
Okay.
that's what I would.
I know at January 1 of every year, we pull all our clientele that is aging in that year. So everybody that turned 73 in 2023 got a letter from us saying, this year you are going to have to take what's known as your required minimum distribution. We'd love to chat with you about it, walk you through how that's going to work. So if you're not getting that communication from your financial professionals, it's probably time to start looking for a new financial professional.
But it will also say how much you have to take out based on your
Gotcha.
age and based on
Yeah.
the account that value.
Okay, and if you're not sure if it's a scam or not, call your financial advisor. Don't just go and start throwing money away.
Oh, absolutely.
Yeah,
Yeah.
never do
Trust
that.
but verify.
Yes, okay. Next up is Carson from Farmville. Carson says, I hear a lot about Roth IRAs. What are they, and is a Roth IRA right for me?
Well, that's a good question. I can't tell you if a Roth IRA is good for you or not, because if you're 58 years old, there's a rule that's implemented that you have to wait 5 years before you can tap into it. So I don't know if that's the best position for you, but the way a Roth IRA works, it's different than a traditional IRA, is you put money in that's already been taxed. So in time, hopefully the investments that you have selected will grow and everything that you start pulling out is now tax-free. But you've got to play by a few different rules, and you can pick and choose the investments that are in the Roth IRA, which we would kindly help you with that if you like. But to answer the question if that's a good place for you or not, I can't tell you, because you might need a tax break now, or you might not be able to qualify for it because you're making too much money. So there are a lot of different moving parts there.
Okay. Cynthia from Lynchburg says, can working with a financial professional like you help me reduce my taxes? I like that question.
I like that question too.
We all want to lower our taxes.
Yeah, the answer is yes. We can help you reduce the taxation you owe.
Oh.
That is because you need, when you work with financial professionals like us, a lot of what we do is look at how are we distributing money to our clients? How are they getting dollars out? What accounts is it coming from? What effect does that have on their tax filings and what they would owe or getting a return if they're lucky enough to get a return. Joke I make with pretty much everybody I work with is we're proud Americans here. We want this for our clients as well. We pay our taxes. We pay our taxes on time and every time. We just don't ever want to give Uncle Sam $1 more than we have to, and that's
Right.
our goal for the clients as well.
And keep in mind, we're not CPAs, so we're not going to prepare your taxes and we're not going to give you tax advice. We can give you strategies to minimize your tax liability. And that's the important takeaway is yes, we can help you minimize your tax liability, but if there are no strategies for you because of your certain circumstances, you might not have anything there.
Okay. Diane from Williamsburg says, I just turned 62 and I'm considering taking Social Security. This won't affect my taxes, will it?
Oh, yes, it will.
Oh boy.
So what I would say to you, that's going to be a situation where if you're still working and you're taking Social Security, that's the biggest thing that I would say to you right now, is because if you're not at full retirement age, and 62 is not full retirement age for everybody that I know.
What is 67?
It depends on when you were born, but most
Oh.
people, it's going to be 67. But
Okay.
dinosaurs like me, it's 66 and so many, okay? But the thing that I would say is understand that if you are still working and you are taking Social Security early before your full retirement age, you're going to have to pay and make more than $17,000, then you're going to have to pay back some of your Social Security.
Oh.
So be aware of that fact, because it's nice to think about Social Security coming to you, a check every month, but if you're still working, it doesn't make sense to do that unless you have some health issues that you think you may not be around here for another 5 or 6 years,
Right.
and you're not going to get any Social Security. But at the same time, if you're married and you're making more money than your spouse, then that would help them out when you pass on.
Right, and that ceiling that you can make increases every year,
Yeah.
and I think it's a little bit higher than the 17 right now, but it changes all the time.
Right.
But the thing to realize is Social Security, until you hit full retirement age and all the way up to age 70, it's right now, it's growing at 8% guaranteed. You can't find that anywhere else. So if you're gonna work and you're not at full retirement age, you're lowering your benefit. You're locking into a lower benefit that was growing at 8% guaranteed. On top of, if you're making more than that ceiling, you're gonna pay the majority of it back to the IRS. So does it make sense to lower your benefit, give up the guaranteed growth, and to not have the
Yeah.
money there?
Yeah, my goodness. All right, one more question before we go. Donna from Richmond says, look in your crystal ball. What are taxes going to be like over the next few years?
I assume Don is talking about income taxes, ordinary income taxes, what we pay on our filings. And Donna, they're going to go up.
Oh.
I mean,
That's a simple answer,
yeah.
but that is a true answer.
I don't know. I'd love to give some eloquent answer there and long-winded, but they are going to increase. We're in a low tax environment right now, even though it might not feel like it to us. We're in a historically low environment, and they are going to increase, unfortunately, and you need to be prepared for that.
So understand, back in the 50s, the highest tax bracket was 95%. Now we're at 20-some%.
My goodness, put
So-
it all in perspective. All right, before we go, our special offer one more time.
Absolutely. So the first 10 callers who save $250,000 or more for retirement, pick up the phone, give us a call, 833-897-4845. We'd love the opportunity for you to come into the office, and we will help you create those tax efficient strategies, the retirement roadmap, anything we can help you with, we would love the opportunity. So pick up the phone, give us a call.
These professionals are the best. They truly know what they're doing. Scan that QR code on the bottom of the screen to schedule your appointment. That wraps up today's show. As always, thanks for joining us on Aspire to Retire. You could be featured on our next episode, so contact us with our questions. We would love to share it right here. On behalf of all of us at Aspire to Retire, I'm your host, Cheryl Nelson. Have a great day.